today is the last lecture, and it has to do with the applications of RF banking. Of course, all of what we have done does not make sense unless you bring it down to an application that benefits the consumer. The consumer can be retail consumers, that is mom and pop and dad and friends and so on at the retail bank, or at the corporate level where you can offer corporate services. The applications can be looked at when you design what we call the investment pyramid. When a customer comes to you and says, I want you to structure a portfolio, there is a whole discipline called portfolio management. The portfolio management discipline would look at the customer and ask him or her a number of questions that will define their investment objectives. Mr. Customer, what is your investment objective? So the customer will tell you, well, my objective is to increase my income. So this is a customer that's looking for an income generating investment. So these people usually are retired people. If a person's retired, he's got a nest egg of $300,000 out of his retirement account sitting in an IRA account at the bank with you. So he will come to you and say, well, you know, I want an income which will supplement my Social Security. So you ask him, what is your Social Security? He will tell you, my Social Security is $2,000. My wife's is $1,500. So our income is $3,500. And the minimum we can live on is $6,000. What can you help me with? So this is a question that's valid for a retired person. The other objective is, well, I am young. Daniel will say, I'm young. I want to invest my savings into something that will grow. So we will tell Daniel that, you know, you might need to want to invest some of a major portion of your portfolio in the stock market. And then we will ask you, what's your risk level? So, because not all people are the same. There are people who are willing to take aggressive steps by investing in stocks which actually are speculative, like Apple. Remember, you know, I remember Apple in 1989 and 1990, actually up to 1998, Apple was selling for $10 and $12. You know how much is Apple now? It's over $600. So that is the thing. But of course, there were people who invested in Apple when it was $60 and $70, but then it went down to $6 and $7 and $8 when Stephen Jobs had his big fight with the board of directors. And I remember that the fellow, Al-Walid, he bought quite a large number of stocks at $6 and $8 and $9 at that time. Now, don't kick yourself in the head and say, well, why didn't I do like him? Well, he didn't do like him because he gets preferential treatment. He gets to be invited by the venture capitalists, by the investment bankers, behind closed doors, and Apple would tell him things that you don't know. Apple would tell him about iPad that they will be producing in 2010. They would tell him about it 20 years before. And, you know, if he believes in it, then he would make the kind of investment. So we're talking about investing in stocks, and that is the thing. So we form what we call an investment pyramid. The investment pyramid basically consists of 3 layers. Like when the ancient Egyptians built pyramids, the pyramids would have a very solid foundation upon which the pyramid is built, and that solid foundation is what we call cash and cash equivalents. Now, why do we need cash? Because sometimes there is an emergency and you need cash. You need cash if your child had to go to the emergency room and you didn't have insurance. You want to spend that money to cover your needs as soon as possible, because you don't have time to liquidate your investments. You don't have time to liquidate your real estate. And by the way, the least liquid asset in investment hierarchy is real estate. And the least liquid assets of real estate is land, because land is not productive, and land takes a long time to sell and to record and to register and so on and so forth. That's why it's the least invested asset. So the three layers is cash and cash equivalent. Cash is cash. What is cash equivalents? Equivalents are money market funds. Now, what is a money market fund? And please understand that when I explain to you these things, I give you a very summarized description of what it is. If you take interest in a certain area, I urge you to go and read about it and educate yourself. What's a money market fund? A money market fund is a mutual fund which has in it a number of investments that would mature every day, such that inside this fund there is always liquidity that's available every day. And in that money market fund, you have a guarantee from the fund manager. It's not a guarantee that is insured by an insurance policy, but it's an understanding, a commitment from the fund manager to give you your whole value of the share. The share value of a money market fund is $1. And he tells you, the manager tells you, that the value of that share will never go below $1. Of course, the word never has been violated in 2008 and 2009, when a number of money market funds had to pay 90 cents on the dollar and so on and so forth. But this was fixed, and the wholesome respect of money market funds was regained. So he will pay you $1 per share, but then he will also tell you that the return on that $1 per share will fluctuate around a certain number, and that number is what we call the money market rate. And that is why when you go to a mutual fund, you can park your money in what we call a money market fund. And many bankers confuse a difference between a now account or a negotiable order of withdrawal account or an income generating account in a banking setup, confuse it with a money market fund. Now, the difference is that in a money market fund, you are not FDIC insured. So what do they do? What they do in a regular money market setup, they go around and they buy bonds with different maturities. And this is where matrices and good portfolio analysis comes in play. So you bring in a bond for about $500,000 that matures tomorrow, and left in it a very small amount of juice, and that amount of juice may give you 2% or 3%. And you keep rotating it such that you have a portfolio which will give you liquidity every day. And when you get that liquidity, you invest again for a short term, and another short term, and another short term, and you keep rolling it into your planning work such that every day you will have liquidity that will make you available to pay those who liquidate their money market funds. Now, of course, in the beginning, it's a hit and miss type situation because you don't know the pattern of the people that are investing with you. But as the money market fund business grew, people knew the pattern of the liquidation within a money market fund. The only time this pattern gets broken is in very unusual situations. And guess what? One of the most unusual situations we would have would be a complete market failure like the one we had in 2008 and 2009, which was created by the collapse of the housing market. So what the managers did, they had no choice but to liquidate at a discount, and when they liquidated at a discount, the value per share was less than $1 for a short period of time. Now, the big question and the big challenge, and this has been one of my dreams, but it hasn't happened yet, and I hope we can make it in our lifetime. Now, what is the big question? The big question is how to structure a money market fund that is riba-free. And believe me, it is much easier than doing the bonds. Why? First of all, the easiest way of doing it is instead of having bonds, you have asset-based bonds, which is what they call sukuk, and you do the same thing as money market funds. But there is a fascinating industry that has not been used to create those money market funds. That industry is called the oil industry and the shipping of petroleum. If you finance the cargoes of ships which arrive every day at some ports around the world, if you finance it using riba-free instruments, then every day you will have liquidation of these ships. You understand what I'm saying? And if you have these liquidations, you will have liquidity, and that liquidity can be used to produce the money market funds. I have been trying to get somebody to work on this for the last 15 years in many conferences and meetings that I go to, but I have not been successful yet. Who knows, maybe God will give us the chance to do it here at LARIBA as we did before. And by the way, most of the work that you'll be hearing about has never been touched by others other than LARIBA. And there are some who are starting to scratch the surface in these applications, but we're very honored and thankful and proud and privileged to have started this work. This is the work that you probably haven't seen, but I'm glad to show it to you for the first time. So the three layers is cash and cash equivalents, which is the money market fund. And then the second layer is what we call income-generating investments. Now, the income-generating investments in a riba setting are usually bonds, real estate opportunities that produce income, or maybe CDs, which are riba-based. In a riba-free setup, we can replace those with sukuk, which are asset-based bonds, and we can replace them with certificates of deposits with a riba-free bank like the Bank of Whittier, which actually gets its income from the rents that we generate from the financing of the different properties we have. Or people can directly invest in real estate that produces income. There's also another source of income investments, but we'll talk about it in the stock portfolio. And these are stocks which are producing dividends. As you know, if you go and visit the history of the stock market, when it was conceived and properly put together, is a different stock market from what we have today. The stock market we have today has become a gambling casino. It is not a true investment. Why? Because the stock market that was perceived in the original development of the stock market was to gather savings from the community and tag it as high-risk savings and investing it in starting Exxon, Mobil, in starting companies like Kellogg's, in starting companies like Procter & Gamble, and so on and so forth. And you keep this money invested in these companies, and the outcome, the profit that these companies pay would be paid back to the shareholders in terms of dividends. Am I clear? You know what I mean when I say dividend?
Yes. Yes.
So these dividends actually people took as a substitute for investing in bonds, government bonds or corporate bonds. And because the investment was very attractive, because Procter & Gamble was making toothpaste for the first time, people bought it, and it is a little bit risky. So if governments were paying 3%, then the dividend on the stocks must have been higher, which is 4 and 5%. Now, starting in 1986, 87, that has changed, and people focus more on what we call capital gains. Well, I don't need dividends. I want to invest in a stock which sells for 10 and I can sell it for 100. And that is what created the gambling casino culture on Wall Street that we're all suffering from now. including the options and so on and so forth. So income generating activities can be government bonds. You know, the United States government issued bonds at a certain rate. It can be, these are riba-based bonds, but of course there is a riba-free government bond which is based on sukuk. For instance, the government of Malaysia issued a number of asset-based sukuk, and the asset in this case would be a highway taking you from downtown Kuala Lumpur into the new airport, international airport. And the toll road that is producing income, that income would give it back to those who invested in this asset-based bond. It was an asset-based bond, again, by the government of Malaysia to collect money from different sources and invest it in the building of the largest international airport in Asia and the most sophisticated. And the income from the airport was given to the people that invested in these sukuks. The income generating investments can be asset-based investment bonds, which actually can build a refinery and can build a high-rise building and so on and so forth. The last category, which I put on the tip of the pyramid, is what I call growth-oriented category, or investing in stocks. And actually, you can take each layer of these layers and, of course, subdivide it. You can subdivide it into a conservative investment, a middle-of-the-road investment, or a high-risk investment, and so on and so forth. And the investment in stocks, of course, is can be in the form of a mutual fund. And, you know, there are so many mutual funds available in the market. And that's a different subject we can talk about later on. So this is the investment pyramid. So if you have to structure a portfolio, you can do that portfolio. Any question on the investment portfolio? Okay, next, what are the guidelines for investing in stocks? I've had the privilege of being asked by a very significant company in riba-free financing back in 1982, and the man who is in charge is a real bold fella, and he really has reaped a lot of profits because of his boldness. I got a phone call from him saying that I want you to start an effort to invest in the stock market, but riba-free. And of course, we did not have any reference to go by. So we started developing the guidelines with a number of others in the team, and we came up with the very first ever riba-free guidelines for investing in stocks in the history of actually the world. And we wrote down these things and polished them and developed them, and I want to share them with you. The two most important guidelines, of course, the details are in the book in chapter 13. The most important two guidelines is, of course, that the product must comply with the Sharia and the laws of the land. In other words, we need to have a portfolio that complies with Sharia and in the same time complies with the laws of the land. And you will notice that every time I mention the word Sharia, I attach it right away with the laws of the land. And this is done not only today for expediency because of those who say, oh, the Sharia is going to do this and that. That was done from the beginning of our effort. Because if you want to be successful in your endeavors, if you benefit from a civilization like this wonderful American civilization, it behooves you. It's your duty, it is your responsibility before God to respect the laws of the land. So the first thing is that it complies with Sharia and the laws of the land. And the products, at least in the beginning, must have the same feel and purpose as those offered by the conventional riba-based banks in order to allow customers to conduct a fair and equitable comparison, and it is preferred to be superior in quality. In other words, if I want to present a product that is riba-free, I will call it riba-free, but then it has to have the same feel and look and name as a riba-based, because the customer has been conditioned for tens or hundreds of years on a certain product, then it will be easier to present it to the customer. So we talked about the cash and the short-term investments, and we talked about the asset-based bonds, and we talked about the guidelines of investing in stocks. What are these guidelines? So the most important guideline, which is missed by most of the so-called riba-free investment mutual funds, is number one, and that is, it is preferred to invest in companies that operate in local communities in order to generate economic growth and prosperity that will result in creating new job opportunities, peace and harmony in the community. This is called in the American Banking Regulation book, the Community Reinvestment Act, that before you invest money in a company that is far away, God knows where, if you're living in California, you invest out in New York, you better invest in a company that is in Pasadena or in Whittier, or if you're living in Nigeria, that is in Lagos. If you're living in Sudan, it is in Khartoum. If you're living in Egypt, and it is Cairo or somewhere in that area before you send your money overseas. The second requirement is that investing should be in socially responsible companies with management that is dedicated to high ethical and moral values. So investing is not only just picking up a company out of a list of companies, and you look at the price-earning ratios, look at the profitability, and look at the history, and go. No, it is much more deeper than that. You look at all of the above, but in addition, you look at the most important factor, and that is the backbone and the core of the company, and that's the ethical and the moral values of the management. What is their value system? What do they stand for? What is their vision? And what do you want to do? Number three, investing cannot be in companies that are obviously involved directly or indirectly in divinely prohibited or haram businesses. Obviously, we cannot invest in beer manufacturing, we cannot invest in alcohol manufacturing, we cannot invest in gambling casinos in Las Vegas and Nevada, we cannot invest in promiscuous activities. These are the obvious ones, but the ones that are not obvious are very interesting. For instance, when we started digging deeper, for instance, you can invest in an airline. Can we invest in an airline? Well, so we looked in the airlines cash flow and where this cash flow is coming from. Well, we found out that one of the important cash flows for airlines are two. One is sales of alcohol in duty-free shops and sales of alcohol on board. And then some scholars said, well, we cannot invest in airline stocks because of that. I'll give you an example, another example. Disney, well, people say, oh, Disney is a great company. It's a company for the kids. They go and entertain themselves in the amusement parks and the wonderful parks they go to. But when you dig into Disney, Disney has many, many other activities that are not Disney, like the Disney you see. For instance, they have a promiscuous movie-making facility that produces a lot of money. They have a movie studio and many, many other things that would render Disney a non-suitable investment that is considered to be socially responsible and a haram activity. The next slide is, we talked about Disney and so on, and then the pork and pork products as well as harmful food industries that we can render harmful based on research, documented research. And tobacco products and arms products, products that actually would cause damage to the environment, products that cause damage to humanity through destruction and so on. And then the second category is a category which has to do with the financial operations of the company. We know that charging and paying entities like banks, finance companies, investment banks, insurance companies, and related businesses, we cannot invest in it. And that's why in any portfolio that is riba-free, you cannot see any banks. And that is the value of what we're doing at LARIBA Bank of America, which is also known as the Bank of Whittier. What is the value? The value is, if we ever go public one day, and I hope it will be in my lifetime, you will have the very first ever listed riba-free bank that the riba-free mutual funds can invest in, and that will create tremendous demand for the stock and will get the stock to skyrocket as never before. Any other environmentally and socially responsible companies you cannot invest in. The second part is the capital structure of the company. Now, what should be the capital structure of the company? And this is what saved us, actually, from the decline. Remember, the stock market declined in '87, and when we were started toying with the idea, was not formal yet, and the stock market declined in 2000 and then 2008. I can prove to you, and I can show you the results. In '87, when the market crashed, our portfolio was up 5%. In 2000, when the market crashed, our portfolio was flat and never went down. And I'll tell you what the secrets are. What happened later on has not been very pleasant in the Dow Jones Islamic Index, and I'll tell you why what happened has happened and the reasons for it. Because people, the problem with people is they start with rules and regulations, and then comes a person who dilutes them. And you remember when we talked about the dilution in Judaism, actually started by Maimonides, and the dilution in Catholicism started by St. Thomas Aquinas, and the dilution in the Protestant Church started by Calvin, and the dilution in the Islamic faith started by many people. We can talk about the names, but will make difference to you. Now, the company capital structure is very important. Now, what we said in the beginning as idealistic Puritans, we said we do not want a company that has any debt. And we went through thousands of companies on the stock market trying to analyze the company's debt and its debt structure. What was the debt? Let me introduce you to a company capital structure. When you start a company, let's say LARIBA or the Bank of Whittier, it has two values. It has a book value. What's the book value? The book value is how much I bought things for. Like, for instance, how much we bought the building for? Well, the building that we own, we bought it for $1 million. But the real value of that building on the market may be $5 million. So there are two values for the company. The book value, which is the number that shows you the history of how much you bought it for, and then the market value, which is how the market values. And then what we call the fair market value, which is how much can we collect when we sell that thing for. The market value is how much the stock is selling for, and that stock can be selling for a very high value because everybody is speculating in the stock, everybody is recommending the stock, or it can be selling at a very low value, which is much lower than the book value, and that would be a tremendous buy if you discover such company. So most of the Sharia scholars and Sharia committees that we sat down with said we don't want any debt in these companies. Let us see what happened. What we found that very few companies actually would qualify for that. Let me see. Yeah, this is the slide I wanted to show you. We conducted research on over 10,000 companies. Believe me, we went through a lot of work, a lot of companies and stocks, over 10,000. And these are the results that we found. The percentage of non-compliant stocks in 2000, 22% operate in prohibited business lines. 62% of the companies practiced what we call excessive borrowing. And 8% of the companies suffered from what we call excessive interest income. Like, for instance, it comes to your mind that, Microsoft has got a lot of cash, swimming in cash. So it must be a good company to invest because they are not borrowing. So, but the problem is they invest their cash in interest-generating activities, and these actually are haram, not acceptable. Or you can look at Apple, lots of cash, Exxon, lots of cash, but then the income from interest is high, and 8% of the companies are actually suffering from this. And then many other exclusions like ethical activities and so on, about 3%. We found that out of 10,000 companies, 9,500 companies must be excluded. And we ended up with 500 companies. And we looked at the 500 companies. We found that these companies are all mostly dot-com companies, because most of the dot-com companies actually they did not take any loans. They just took venture capitalists' income and capitalist investments. And because it's venture capital investment, there was no debt on the books. And that's when we decided to sit down and group again and revisit the whole issue. This was really a very decisive moment in our analysis. Now, after long discussions with the scholars and with our team, we sat down and said, well, let us do some what we call qiyas. Qiyas, which means trying to compare what people decided on in the past with what we have at hand. And we decided that we will use the laws of inheritance that were in the jurisprudence, which allows you to change the distribution in your lifetime, not after your life, in your lifetime, up to 1/3 of your assets. And that's when we expected the next ruling, which said that the ratio of debt to total capitalization of the company should not exceed 33%. Is that clear? And the whole idea was to diversify our investment portfolio so we can cover many industries. In other words, if a company is capitalized at $1 billion, the debt of that company should not be more than $300,000, and the rest is the capital. Now came the next question. How do you measure the capitalization of the company? Do you measure it as the book value of the company, or do you measure it as the stock market value of the company at the closing of the days? My position personally and others was to use the book value of the company, because this is a true description of what the value is. And this is what I used in my portfolios, and this is what I say, what saved my portfolios and gave me very good performance, is that you always look at the book value of the company. Why? Because it reflects a real value of the company, and it gives you a potential for appreciation what people discover. Well, slowly people deviated away from this, and by 2006, they decided that it is not the book value, it is the stock market value. So when you do the stock market value, you right away have thrown away all these rules and regulations, and you become a player with the herd and a speculator with the speculators, and that's what happened when the crash came. It hit everybody. But if you stick to your values, you would be in good shape.
I have a question, doctor. What if the market value is lesser than the book value?
Oh, that would be a great investment. And that we call that in the investment discipline undervalued stocks. Undervalued stocks are stocks like, for instance, people, I don't like that brand anymore, but you look at the assets of that brand, of that company, they are much more than they are selling for. And that is how people make their money. That's what Warren Buffett does. Warren Buffett, he buys the company when it was really down in the bottom, and he sits in it until its value is discovered. And when the value is discovered, he sells it. He doesn't sit in it. This is exactly what he does. And this is exactly the whole idea of what we develop as riba-free financing. And we can talk in an advanced course on some very interesting results, but I think this is enough. Another major area erupted with the minimum debt, and that is come with the dot-com companies. Now, the dot-com companies actually were a wonderful investment idea that captured everybody's imagination and so on and so forth. And the question was, is this something that you can invest in or not? And the answer was, you have to have a company that has to have a certain tangible product that is beneficial and a track record that you can build on, and that actually has excluded many of the speculative dot-com values. The other thing is, what about companies that generate interest income, like, for instance, banks, insurance companies, or, for that matter, companies that are sitting in a large amount of liquidity of cash, who invest in bonds and stocks? Actually, we put in a limit of it should not be more than 5%. And that should not be more than 5% based on the interest income was extended to other activities. Like, for instance, if you have Subway sandwiches, which sells pork and pork products, and then a person who does want to start a riba-free Subway sandwich, the ideal way is to go and tell Subway, I cannot sell pork. Actually, it was achieved in England. And here in the United States, it cannot be achieved. So we tell them that, well, you undermine the advertising for the pork such that your income should not be a major source of income from the pork sales. 3%, 2%, but less than 5%. The next point is the investment should be in actual stocks that are backed by operating and existing companies and not just the paper indexes. You cannot invest in the index, but you have to invest in the stocks. In other words, you cannot invest in the oil index. You cannot invest in the financial index. You cannot invest in something that is paper. It has to be based on actual stocks with a performing measurement and results. I want to show you another interesting application, and I'm sorry I'm giving you bits and pieces because that's not the intent. The intent is to give you a texture, a feel of what is done and what we can do and expand. This is the S&P 500 index measured not in US dollars, but in ounces of gold. In other words, if you pretend that you are now buying the S&P 500, which is the measure of the stock market, in gold or in rice or in wheat, and we have the data for all of this stuff, what happens? You will find that the stock market actually was overvalued until the oil shock of 1973, when the financial markets changed drastically. I want to let you in on a secret. When I was doing my MBA program in 1972, 1973, 1974, 1975, 50% of the course contents in the business schools was dedicated in an organized fashion to one important thing, and that is to undermine the idea of stable gold-based currencies into the new and fashionable trend of fiat money. And I used to make presentations on this stuff in classes, in groups, and so on and so forth, and I didn't know what was the intent of putting us into that until recently when I started doing this work. You can see, and I'm sorry I don't have a pointer, but you start from 1968, and you can see how it was high, and then with the new monetary regime, it suddenly dropped big time, and then started fluctuating into this channel, and then the bubble started building and building and building and building until the first bursting of the bubble in the year 2000. And the bursting was not complete. It continued on and on and on until 2008. And if you want to ask me now about the market, where it is fully valued, as we always have said for the last 4 or 5 years, those who have been listening to me. The next is the NASDAQ. Same story in NASDAQ. NASDAQ was very much undervalued. Look at the value of NASDAQ in 72, 73, 80, 88, 92, 96, and then slowly booming in the bubble, and the bubble has burst, and then now NASDAQ is very well priced. And if you have any questions, I'll be glad to answer it. And thank you very much for your patience. There is a whole new subject that is also in the applications, which I didn't mention because I didn't want to bore you with it. And these are trusts which are devoted for nonprofit organizations, what we call awqaf or waqf. And by the way, I'm very happy and privileged to tell you that LARIBA was the first ever in the history of the world to arrange financing of two major waqf in Singapore. I told you about the situation in Singapore. In one of my visits to Malaysia, I was sitting in the office of Dr. Mahathir Mohamad, and he was telling me about the history of Malaysia and Singapore and so on. And he said, Yahya, you should go and visit Singapore and meet with the people of MUIS, which is the organization. So I went there and I had a meeting with them, and they were telling me about a very sad situation where some of the waqf that were pledged by the Indians who went to Singapore when it used to be part of Malaya or the Malayan Islands, they actually ended up into the middle of the most prime area in downtown Singapore. And of course, the community there did not have much money to develop it, so the government told them, if you don't develop it by a certain time, the land will be taken away from you. And indeed, one of the very, very expensive properties was taken away from them. That is which prompted us to develop two properties which are in downtown proper. One which was actually a high-rise building that we built, 25 million Singapore dollars, and we arranged the structuring and the planning and the model that was used. And the second one was a $35 million building of a long-term hotel on the parking lot of a very historic mosque or masjid in Singapore. And I just want to tell you that all of this was done free of charge as a donation in the way of God, and I'm sure God has been paying us back for this. If you want to read more about it and the details of the waqf or the trusts and the rules of the trusts and so on, which actually we did a lot of work on, you're welcome to read chapter 13. Where do we go from here? We go to what we have started, and that is the popularization of RF banking. And RF, we all know, stands for R is responsible, F is finance. R stands for RIBIT, and F stands for free. And R stands for RIBA, and F stands for free. And that is the task that we all stand for. And I'm very honored and proud to be working with you, because you are the ones who are going to make it happen. Thank you very much. And if you have any questions, we'll open it up.
Quick question, please. Exchange-traded funds, is that the same prohibition as index funds, or is that allowed?
If it invests in funds, that's fine. But if it invests in the index in a speculative manner, that's not fine. Okay. There are and you have to read the prospectus carefully and so on.
On the graph for the ounces of gold, the
right.
Ounces of gold, the two bands that are an estimate of the fair market or the estimated real value. How do you come up with the two bands?
The band we come with it using technical analysis technique that we have developed in first in the analysis of noise and main waves in electrical engineering applications, and then later on in what we call technical analysis in the stock market. And actually, in the class I'm teaching here in Dallas, I am very lucky to have 3 TI engineers who specialize in this thing, and we're working on researching this and coming up with equations on the thing.
You were mentioning earlier, Doctor, about international investments, international bonds. So can a local investment broker, let's say, can they offer insurance for infrastructure bonds that are, let's say, in Malaysia or Singapore, even though that the investors are domestic here in the United States? Is there insurance that's offered for that? So will the SIPC cover that?
There is, well, whatever, a bond is an IOU piece of paper. You can ask for whatever you want. If it's available, you can do it. But a bond is a bond, and you cannot insure a bond. You can insure the house that would keep the bond in its portfolio, but you cannot insure the bond. Like when Lehman Brothers fell, Lehman Brothers fell as a house, and then its bonds also fell down, and so on and so forth.